Last month, I looked at a law firm's books and found $47,000 in write-offs. Not over a year, 1/4. When I asked the lawyer about it, he shrugged. Cost of doing business, he said. Except it's not. That $47,000 is a diagnosis. Most lawyers know their write-off total. What they don't know is why those write-offs happened. They treat them like weather. Some years are rainy, some aren't. But write-offs aren't random. They're financial signals. And if you're not reading them, you're missing the clearest picture you'll ever get of where your practice is broken. Here's what I do with every new law firm client. I pull their write-offs from the past year, not the total, the actual line items, and categorize them by cause instead of by client or matter. The patterns are almost always the same, and your write-offs probably fall into 4 buckets. First, there's scope creep that you ate. The client called with one quick question that turned into 3 hours. You didn't bill for it because you never set expectations up front. So you absorbed it, told yourself it was good client service, and moved on. Multiply that by 20 clients, and you've got a real number. Next, there's stale invoices. You billed 4 months after the work was done. The client pushed back, maybe not even that hard, and you caved. Here's the thing about old invoices. By the time they're 90 days out, you're not collecting anymore. You're asking for a favor. Third, there's rate discomfort. This one's sneaky. You looked at the invoice before you sent it, thought, that's too much, and discounted it before anyone asked. The client never complained. You just didn't believe your own number. And finally, there's surprise bills. The client was shocked by the total, not because it was wrong, but because you never told them what to expect. Now you're writing it off to save the relationship. Maybe that's the right call. It's still a symptom. Once you sort by cause, write-offs stop looking like bad luck. They start looking like a to-do list. Here's a related pattern. Accounts receivable sitting past 90 days. I see firms with $150,000, $200,000 in AR that they're never going to collect. They treat it like a bookkeeping problem. It's not a bookkeeping problem or software problem. It's a client relationship problem wearing an accounting costume. Old accounts receivable means one of 3 things. It could be the client is unhappy and hasn't told you. They got the bill, didn't like something, and instead of calling to complain, they just stopped paying. That invoice is still sitting there because nobody on your side picked up the phone. Or maybe your billing is too slow. Work from February gets invoiced in April. By then, the client has mentally closed that chapter. The bill feels like an ambush. Or perhaps nobody owns collections. No follow-up at 30 days, no call at 60. The invoice ages out because it's everyone's problem, and therefore no one's. You can't fix a relationship problem with better accounting software. There's one more pattern, and it's the hardest to catch because it doesn't show up on any report. It's the write-off you take before you send the invoice. You look at the time entries. 3 hours drafting, 2 hours revising, 1 hour on calls. You think, that's too much for this matter. So you knock off 2 hours before the bill goes out. Nobody asked you to. The client didn't complain. You just decided your time wasn't worth what you recorded. This happens constantly. I catch it by comparing timekeeping reports to actual invoices. The gap between worked and billed is money you earned and gave away before anyone had a chance to object. Sometimes there's a reason. You made mistakes, the work took longer than it should have. But most of the time, you don't believe your rates. You think you're too expensive. So you pre-discount and then wonder why the math doesn't work at the end of the year. Not all practice areas have equal margins, and if you're not tracking profitability by practice area, real profitability with write-offs included, you're guessing. Immigration and family law have the highest write-off rates in my client base. Not because the work is worth less, because the billing model fights the reality of the work. You set a flat fee before you understand what you are walking into. The scope expands because personal legal matters are messy. The client can't pay what the work is actually worth. And you absorb the difference because the alternative is a hard conversation you don't want to have. Estate planning on flat fees tends to hold margins. The work is predictable, the deliverables are clear, and the scope doesn't explode mid-matter. If you don't know which of your practice areas is bleeding, you're subsidizing bad business with good. Let's look at an example of how one firm addressed their write-off problem. One of my clients tracked write-offs by cause for 6 months. The results weren't pretty. More than 60% of their write-offs came from 2 sources: invoices sent more than 45 days after the work was done, and scope changes with no updated fee agreement. They fixed both by billing every 2 weeks and by adding one line to their engagement letter that says, "Additional work outside the scope will be billed separately after written approval." Write-offs dropped 40% in 1 quarter. Same clients, same attorneys, same work, different systems. So it's time for you to find your $47,000 leak. Pull your write-offs from last year, not the total, the line items. For each one, ask, what actually happened here? Don't accept "the client complained" as the answer. That's the symptom, not the cause. Was the bill a surprise? Did you wait too long? Did you underquote and hope? Did you discount before anyone asked? Keep a list. After a month, you'll see your patterns. One firm I work with wrote off $15,000 last year because the same partner kept forgetting to get engagement letters signed before starting work. That's not a billing problem. That's an intake process problem. Write-offs aren't paperwork. They're financial signals. They're telling you exactly where your law practice leaks money. You can keep shrugging them off as the cost of doing business, or you can start paying attention. Unsurprisingly, $47,000 buys a lot of attention.